Hi, Martin Turner here. Welcome to our class on how to predict the future to eternity. We first look at risk and the importance of having a margin of safety. We also review aspects of measurement of risk using betas in finance theory. We then look at using continuing values to capture our view of the future of our firm beyond the forecast horizon. Where we use perpetuities to include our estimates of cash flow and economic profit to eternity. And we also look at the importance of including sensitivity analysis in our valuations. First, let's look at the important concept of margin of safety to help us get the risk-return relationship in our favour. Hi, Martin Turner here, and welcome to the Week 11 lecture for ACCT13017 Financial Statement Analysis. How to predict the future to eternity. Now, today we'll review Week 10, and then we'll have a look at the key concept of margin of safety. And then we'll have a look at the continuing value, a concept, and explore some aspects of that. Now, last week, we looked at focus on the enterprise, and we focused on the cost of capital for operations, the weighted average cost of capital. And we've used that as we focus on the enterprise, and that doesn't change with changes in debt. It changes in its financial structure. And then we had a look at levered and unlevered ratios. We saw that a lot of the ratios that are shown in the financial media they're often levered ratios, and those do change and are affected by the amount of gearing or debt in the business. And we also saw unlevered ratios, which are not affected by the financial operations of the firm. So we're going to have a look at safety, at margin of safety. Warren Buffett, the three most important words in investing: margin of safety. Arguably the most successful investor in our generation. The three most important words in investing: margin of safety. Well, that's what we'll be looking at now. The margin of safety is the idea that when we're transacting, that we should have a margin between what we think the firm is worth and what we transact at. So if we were buying, say, shares in Ryman Healthcare, we would want to, if we value it at a certain amount, we would want to have a margin of safety. So we buy it for less than that. So a margin of safety around about 30%. So if we thought it was worth say $15, then 30% for $4.50. So it would be, you wouldn't buy until you could get it for $10.50 or less. And it's the opposite when we're selling, that we'd only sell, say, with a margin of safety, say, of 30% above. And the reason for that is that firms are not fully predictable. We can only forecast aspects of their future. So there's a lot of uncertainty around our valuations. But if we have a margin of safety when we're transacting, then that can skew the risk return into our favour. And it's also important to do sensitivity analyses with our valuations of our firms, change some of the inputs and see what effect it has on our measure of value. That helps us get a bit of a sense of risk in our valuations as well. There's a great short video, Margin of Safety, and you can have a look at that. It's a live link in the slides, also in the videos section, and that'll explain further this concept of margin of safety. And so the key is sensitivity analysis. Margin of safety and doing sensitivity analysis acknowledges that there's a risk around our valuations. We can come up with our valuations to a very precise figure, and we will. But that doesn't mean that there's a lot of uncertainty around that in terms of our forecasts. And so we can change a few of the inputs and see what effect it has on our valuations. And it is when we are seeing that our firm can have multiple potential futures that we're engaging with the risks of our firm. And you can have a look at the video Risk Finance Theory, at that short video, to get an idea of how finance theory views risk and how that's different to the way we're talking about looking at risk here. And so we know we're engaging with the risks of our firm if we're looking at a range of potential values at a sensitivity analysis. So you should do a sensitivity analysis on your valuations. Now, an important part of our values for our firm will be the continuing value. We're going to be forecasting for 5 years, and that will be our forecast horizon. And then, but of course, our firms can be expected to go on a lot longer than 5 years. And so what happens there? So we'll be using a continuing value to encapsulate our assumptions about what we expect may happen after our forecast horizon. Now, here are the formulas for the continuing value, both under the DCF, discounted cash flow model, and the economic profit model. With the DCF model, the continuing value little t is the forecast horizon, so that would be 5 for us. So the continuing value in year 5 is the operating income in year t plus 1, which is year 6 for us, all times 1 minus, in brackets, G divided by RINOA, close square brackets, divided by weighted average cost of capital minus G. And then for the economic profit model, we've got that formula there, where we use economic profit rather than operating income. And the formula is a little bit more complicated. Now, in those formulas, these are perpetuities. There's G equals the expected growth rate in operating income. And RINOA is the expected rate of return on incremental net operating assets, which is the incremental or extra capital that we would need to invest, our firm would need to invest after the forecast horizon. And RINOA is our assumption on that expected rate of return on that additional or incremental net operating assets. So RINOA equals the expected rate of return on incremental net operating assets, return on incremental net operating assets, which is the new invested capital that is presumed to be invested after our forecast horizon in order to support our growth after that. Now, the continuing value formulas are perpetuity-based formulas. They assume a constant growth rate in operating income and a constant expected rate of return on incremental net operating assets. And you can see that we have constant growth. So you can see the G in both the continuing values for the DCF model and the economic profit model. That's a constant growth rate in operating income. So we might assume operating income will grow by 2% every year forever in our continuing value. And that's what our spreadsheet will calculate our continuing value for us and use that figure that we put in for growth rate, expected growth rate and operating income into the continuing value formulas. So the perpetuity has constant growth and also constant margins and asset turnover. The return on incremental net operating assets equals profit margin times asset turnover. So we're going to be assuming a constant return on incremental net operating assets. So with constant margins, profit margins, and asset turnovers. And also with constant weighted average cost of capital. So our measure of risk. We'll also be putting that into the formula. So this is a perpetuity. It assumes a steady state in our growth rate in operating income, in our weighted average cost of capital, and in our constant margins and asset turnovers. So that's what makes up our perpetuity-based formulas for the continuing value under both our models. Now, you'll see when you calculate the value of your firm and start using the spreadsheet and run a few sensitivities that the value of your firm will be the same with either model, given the same projected financial performance. So with the same view, same inputs, the two models will come up with the same value. Now, the economic profit model is a perpetuity with the economic profit, the continuing value in year 5, which will be the forecast horizon. The end of year 5 will be the economic profit we forecast for year 6 divided by the weighted average cost of capital. That's a perpetuity, and will be if our return on incremental net operating assets equals our weighted average cost of capital. Say we had weighted average cost of capital of 8% and we used return on incremental net operating assets of 8%. So in other words, the returns we're getting on that additional net operating assets that we're assuming is being invested to support growth in the business after the forecast horizon. If that's the same as weighted average cost of capital, there's no value add there. And if that's the case, then in that formula, RINOA minus WACC will be 0, and all that red part of the formula will be 0. And then the economic profit model continuing value would simply be economic profit divided by the weighted average cost of capital. And that's a simple perpetuity. Now, there are traps with continuing value scenarios. We can assume the past will continue indefinitely into the future. So for Ryman Healthcare, for example, and for all our firms, that's probably unlikely to occur. Things for Ryman Healthcare, you can expect other competitors to enter, and that is happening into their markets, and to have increasing competition. Customer acceptance of the sale of occupation rights might change. Ryman Healthcare doesn't sell the units themselves to people, it just sells like a lifelong lease or occupation rights. And that may come a time where that's not acceptable to customers. The market for retirement village units may become saturated. There just might be heaps of retirement villages everywhere, and that will reduce the opportunities for future growth for Ryman Healthcare. So there's all sorts of things that can happen in our firm's businesses. If, in case of Ryman Healthcare, a very successful business, but it's unlikely to continue on forever. All sorts of factors will tend to, over time, change the situation for Ryman Healthcare. And so we incorporate into the growth rate into our continuing value a sense of what might happen in the future, and it's very important to run sensitivities on that and on all our inputs into the firm's continuing value to check out what happens if, as we move, for example, the growth rate in operating income in our continuing values. So sales, asset turnover, profit margin that feed into the abnormal operating income can be driven by all sorts of factors. Residential property values is an issue, one of the factors for Ryman Healthcare, that depending on what happens to that, there's been a bit of a boom in residential properties in the last few years. Then it tends to flatten out and then tends to go to another boom, or it might go backwards sometimes. Those residential property values will be an impact on how Ryman Healthcare goes in the long term. And also the sales of occupation rights, how much demand there is for it, and whether this strong demand to be going into retirement villages continues. So what did we look at today? We looked at the margin of safety. Warren Buffett said it's the 3 most critical words in investing. Margin of safety. So if you remember anything in this unit, remember that. And that is having a margin between what you think a firm is worth and what you're prepared to transact at. Margin about 30%. So you'd be a buyer of a stock of a company's shares when it gets to be 30% less than what you think it's worth. And that's to give you a margin of safety to the extent that your forecast could be wrong. And so that if it's a sufficiently big margin of safety, that will reduce your risk than if you're wrong to being that wrong. And we looked at the continuing value and we drilled into that a bit, and we saw that it's a perpetuity, a fairly complicated looking perpetuity, and that it has some assumptions around growth rates of operating income and of weighted average cost of capital and of our return on incremental net operating assets, the returns we assume we'll get on the extra investment into the future to support the growth of the business. Well, thank you very much, everyone, and I look forward to continuing to work with you in the coming week. Bye for now.